What type of insurance offers permanent life coverage with premiums that are payable for life? Credit life, renewable term life, whole life, endowment. The correct answer is whole life. Whole life is considered permanent coverage because the coverage is permanent for your whole life. In turn, you also usually make payments on a whole life policy for your whole life. For example, if you take out a $20,000 whole life insurance policy and agree to pay a premium of $30 a month, the $20,000 of coverage will last your whole life, and you will be required to make the $30 a month premium payment for your whole life. When is the face amount of a whole life policy paid? At the policy's maturity date only, when the insured dies, or at the policy's maturity date, whichever happens first, only when the insured dies, when the policy is surrendered. The correct answer is when the insured dies or at the policy's maturity date, whichever happens first. Remember, a whole life policy will always pay the face value or coverage amount when the insured dies or at the policy's maturity date, whichever happens first. Most whole life policies have a maturity date of age 100. A life insurance policy that provides a policy owner with cash value along a level face amount is called whole life, level term, credit life, ordinary life. The correct answer is whole life. Remember, two of the features of a whole life policy that are always true are cash value and a level face amount that does not change from the date the policy is issued. For example, if you purchase a life insurance policy with a $20,000 face value or coverage amount, that $20,000 coverage amount will be level from day one until the end of the contract. Which statement about a whole life policy is correct? Beneficiary may be changed only with the consent of the premium payer. Death benefit can usually be adjusted. Cash value may be borrowed against. Premiums are flexible. The correct answer is cash value may be borrowed against. The cash value of a whole life policy offers the policy owner a savings account available to borrow against while the insured is alive. Any money borrowed from this account and not paid back before the insured's death will be subtracted from the face value prior to the beneficiary being paid. Which of these characteristics is consistent with a straight life policy? Owner can adjust both premium and death benefit. Premiums are lower for the first 5 years, increase the 6th year, then levels off for the remaining length of the contract. Owner has the option of converting to term insurance. Premiums are payable for as long as there is insurance coverage in force. The correct answer is premiums are payable for as long as there is insurance coverage in force. With straight life, you are agreeing to pay on your whole life policy for as long as coverage is in force. Said differently, you will be paying until death or age 100, whichever occurs first. T would like to be assured $10,000 is available in 10 years to replace a roof on his house. What kind of $10,000 policy should T purchase? Interest-sensitive whole life, 10-year endowment, variable universal life, 10-year renewable term. The correct answer is 10-year endowment. It's basically a whole life policy with a small face value and a short maturity date. For example, 10 years. Once the policy matures, the policy owner will receive the face value. K pays on a $20,000 20-year endowment policy for 10 years and dies from an automobile accident. How much will the insurance company pay the beneficiary? Return of premiums paid, cash value plus interest, $20,000 death benefit, face amount plus interest. The correct answer is $20,000 death benefit. Remember, endowment policies are basically whole life policies with a short maturity date. If the insured dies before the maturity date, the beneficiary will receive the face value, just like any other whole life policy. Life insurance that covers an insured's whole life with level premiums paid over a limited time is called adjustable life, renewable term, limited pay life, joint life. The correct answer is limited pay life. Since a limited pay life is whole life, we know coverage will last for your entire life. You will have cash value, a level premium, and a level face value. With the limited pay life, you are agreeing to pay for your whole life policy in its entirety by a predetermined date, limiting how long you pay for the policy. How long does the coverage normally remain on a limited pay life policy? Age 65, age 100. When premium payments stop, at the discretion of the insurer. The correct answer is age 100. A limited pay policy is a whole life policy where you are limiting the amount of time you are required to pay premiums. Since limited pay policies are whole life, coverage on a limited pay policy lasts until death or age 100. What type of policy would offer a 40-year-old the quickest accumulation of cash value? Paid up at 65, 20 pay life, 30 pay life, straight whole life. The correct answer is 20 pay life. The quicker you pay up your policy, the quicker you will accumulate cash value. If you are 40 years old and pay until age 65, you will pay a total of 25 years. With a 20 pay life, you are only paying for 20 years. As this is the shortest payment period, you would begin to build cash value the quickest. N is a 40-year-old applicant who would like to retire at age 70. He is looking to buy a life insurance policy with level premiums, permanent protection, and be paid up at retirement. Which of these should N purchase? 30 pay life, term to age 70, universal life, adjustable life. The correct answer is 30 pay life. Since a limited pay life is whole life, we know coverage will last for your entire life. You will have cash value, a level premium, and a level face value. If N is 40 years old, will retire at age 70, and wants to have his life insurance policy paid up by the time he retires, he should purchase a 30 pay life. A potential client, age 40, would like to purchase a whole life policy that will accumulate cash value at a faster rate in the early years of the policy. Which of these statements made by the producer would be correct? Straight life accumulates faster than limited pay life. 20 pay life accumulates cash value faster than straight life. Cash value accumulation of both 20 pay life and straight life depend on the insurer's financial rating. 20 pay life and straight life accumulate cash value at the same rate. The correct answer is 20 pay life accumulates cash value faster than straight life. Remember, the quicker you agree on having a whole life policy paid up, the quicker you will accumulate cash value. K buys a policy where the premium stays fixed for the first 5 years. The premium then increases in year 6 and stays level thereafter. All the while, the death benefit remains the same. What kind of policy is this? Variable life, adjustable life, graded premium whole life, modified whole life. The correct answer is modified whole life. Since a modified whole life is whole life, we know coverage will last for your entire life. You will have cash value, a level premium, and a level face value or coverage amount. The only special feature of a modified whole life policy is the insurance company gives you a premium discount for the first 5 years. Q would like to purchase $100,000 of permanent protection on his wife and $50,000 of term coverage on himself under the same policy. What kind of policy should Q purchase? Joint policy, joint survivor policy, whole life policy with other insured rider, whole life policy with a guaranteed insurability option. The correct answer is whole life policy with other insured rider. Other insured riders can only be temporary or term insurance. Both Q and his wife would have their own face amount, but if Q's wife dies first, Q would lose his policy because it is riding on hers. If her policy goes away, there is no longer a policy for his to attach to. Which of these statements describe a modified endowment contract? Falls below the minimum amount of premium that can be paid into a policy and still have it recognized as a life insurance contract. Exceeds the maximum amount of premium that can be paid into a policy and still have it recognized as a life insurance contract. The 7-pay test is used to determine the minimum death benefit of the policy. The 7-pay test is used to determine the maximum death benefit of the policy. The correct answer is exceeds the maximum amount of premium that can be paid into a policy and still have it recognized as a life insurance contract. A policy is considered overfunded by the IRS's 7-pay test if more than 7 years of premiums are paid into the insurance account at once. If this happens, the IRS no longer allows the policy to be recognized as a life insurance contract. It is now viewed as an investment and loses the favorable tax benefits of an insurance policy. Which type of policy is considered to be overfunded, as stated by IRS guidelines? Modified whole life, modified endowment contract, variable universal life, interest-sensitive whole life. The correct answer is modified endowment contract. The 7-pay test was developed by the IRS to determine if excess premiums were being paid into a whole life insurance policy to take advantage of the favorable tax benefits incorporated into whole life policies.